If you had only $100 right now, what would you do? Wait, before you answer, 90% of people who invest their first $100 pull all their money out within the next 6 months. They don't make zero, they actually end up at a loss. And the reason isn't what you think. It's not bad luck, it's not picking the wrong coin, it's one small mistake you'll learn about by the end of this video, and once you find out, you'll change your entire plan. So if you've got $100 sitting there, and you're wondering how to invest it without losing your money, watch this till the end, because the last step is the one most people miss. Most people think investing your first $100 means finding the right stock or the right coin. Like there's some magic pick that'll double your money overnight. But the truth is, your first $100 isn't about a winning pick at all. It's about building a system. You need to turn yourself into someone who invests consistently, calmly, and automatically. Because the difference between people who build wealth and those who don't isn't intelligence, it's behavior. And behavior is what destroys beginners. Fear, the urge to get rich quick, ego, and impatience. In 2024, the average investor earned only a 16.5% return, while the market itself gave over 25%. Why the gap? Because people buy and sell at the wrong time, not the right time. So this video will do two things. First, show you a simple plan for your first $100. Second, show you the mental traps that make people quit. Before investing, ask yourself one question: if an unexpected expense came up tomorrow, would you need this money back immediately? If the answer is yes, then investing right now shouldn't be your first move. Many people can't even cover a $400 emergency with cash, and if you're forced to sell your investment at the wrong time, investing didn't help you, it hurt you. Now think of your $100 in 3 buckets. First bucket: safety. If you have zero emergency savings, the smartest move is to put this $100 into a savings account. It doesn't feel like investing, but it supports your future investing. Because when financial stress hits, the brain doesn't think calmly about the long term, it just says, I need money right now. That's exactly why people sell at the wrong time. Second bucket: guaranteed return. If you have high interest debt, like a credit card charging 25% interest, pay that off first. Paying off that debt is itself a guaranteed 25% return, something no stock market can ever guarantee. Third bucket: actual investing. If you have a bit of a buffer, no urgent debt, and you can leave this money untouched, now we invest. And I'll say it directly, your first $100 shouldn't go into an individual stock, a meme coin, or a penny stock. You might get lucky, but that's not investing, that's a lottery. The simple approach is buy the whole market. A low-cost index fund, like a total market fund, an S&P 500 fund, or a target date fund. Why? Because even professional fund managers mostly can't consistently beat the market. If professionals can't do it, a beginner isn't going to do it with $100 either. Now let's look at the actual steps. First, choose an account, whichever has the lowest fees and is most tax efficient. Second, pick just one fund, don't overcomplicate it. Third, invest your $100 these days. Fractional shares are available, so even if you can't afford a whole share, you can still invest. And fourth, the most important step: automate your next contribution. This is the real secret. Your first $100 doesn't matter much. What matters is the habit. So keep automatically investing a small amount every week or month. If you invest $100 just once and never add to it, at a 7% return, after 30 years, it becomes about $760. Not much, but if you automate $25 every week, after 30 years that amount becomes about $120,000. The reason wasn't genius, the reason was consistency. And now, the thing most people ignore: fees. Some actively managed funds charge around 1% per year, while index funds charge close to 0.05%. The difference looks small, but compounded over decades, it turns into a huge loss. So always choose low-fee funds. If all this is so simple, why don't people do it? Because your brain works against it. The brain wants excitement, an index fund feels boring. Trading feels exciting. The brain fears being wrong, so when an investment drops, people panic sell. The brain wants control. Picking a stock feels like control, while buying the market feels passive. But ironically, doing less is the strategy that wins more often. So remember the simple plan: if you don't have emergency savings, build a buffer. If you have high interest debt, pay it off. If you can leave the money untouched, invest in a low-cost, broad index fund. Then automate your next contribution. And most importantly, keep it boring. Keep it consistent. Most people never invest their first $100, not because they can't, but because they keep waiting for the perfect moment. But the people who build wealth don't depend on perfect timing, they build better systems. So, here's your challenge. In the next 24 hours, do one thing: either put $100 into an emergency buffer, or invest it in a low-cost index fund, or at least open an account and get ready. Then automate your next contribution, even if it's just $10. Because one day, you'll look back and realize the biggest change wasn't the money, it was you.